Today we're going to talk about chapter 12, and chapter 12 is relevant cost for decision making. It's interesting chapter, very practical again, and using the knowledge that we have from all the course up to this point, from cost classification, different cost classification, from the cost volume profit analysis, for to some extent of the job costing, and we're going to see how it goes. So relevant costing for decision making. What's important with this? Now, when we're making decisions, you have to understand that two costs which are important. The relevant cost. A relevancy cost obviously will be the cost that will be the difference between one decision and another decision. That will be the one that you first is going to look for. The second one is the avoidable cost. And the avoidable cost will be the cost that can be eliminated if some or the entire thing of that cost can be eliminated by choosing one alternative or another alternative. So basically, if technically, if you want to go to the concert and you have to pay $150 for the ticket, that would be one thing, and then go to buy coffee, but then you don't have to buy $150. So avoidable, whatever you can avoid as a cost that you currently have, that will be also considered in your decision. Probably the ticket wasn't a good example. Probably that will be if you have a cell phone, you need to pay for the cell phone $50, and you have a new offer for another cell phone, for which cell phone you have to pay only $20. So the $50 that you can avoid by switching to the new decision, that's also will be relevant for making a decision. Now, the avoidable costs are relevant costs. The costs that you can not avoid, those are irrelevant costs. Now, there are two broad categories of the cost which are never relevant. First one is the past cost, or something that we already paid for, called sunk cost. And the other one is the future cost, which are not different between alternatives. For example, if you have to go to the airport, and you have two options. One option to go to Miami, the other option is to go to Hawaii. In both options, you have to go to the airport. So the cost going from your home to the airport, it will be irrelevant cost. Why? Because that cost cannot be avoided, regardless which decision you're going to get. Now, there are some steps in the process of evaluating decisions. First step is to eliminate the cost and benefits which are not different between the alternatives. So basically, you have two options. One option is option A and option B. So first, you're starting to look at which costs are exactly identical in both alternatives, and which benefits are exactly identical in both options. So those are eliminated. Then use the remaining costs and benefits, which are different between the alternatives, and make the decision. The costs that remain are differential costs, or avoidable costs, or just costs. Now, the costs which are relevant in one situation may not be relevant in another situation. That's another thing that you have to understand. So it depends on the situation. So you have to understand, for the different purposes, we're going to use different costs. You cannot, there's no template here. You cannot just apply the same approach for all the decisions that you make in your life. So let's see one example. There's a student who wants to go to her friend, but she has to go to another city, which is called Windsor, but she's living in Toronto. She has two alternatives. One alternative is to go with her car. The other alternative is to go with the train. Now, if she decides to go with her car, she has to drive 230 kilometers in one direction to her friend and partner. Now, she's trying to make a decision. Which alternative is less expensive? Again, the two alternatives is to go with the her car, or the second alternative is to go with the train. Now, there's some information which is provided, and now we have to identify which one is relevant, which one is not relevant. So again, remember, step one, we're trying to eliminate all the costs which are irrelevant or the benefits which are the same. First one, straight line depreciation on the car. She has calculated an annual cost or a cost per mile. Now, the straight line depreciation of the car, well, the car is going to depreciate regardless if you use it or not. So the fact that she did in both alternatives, in the train and driving the car, that depreciation will be there. So basically, the depreciation will be eliminated as a cost for decision making because it's irrelevant cost. In both cases, that cost is going to stay there. So it's not relevant for our decision. Cost of gasoline. Well, if she goes with the train, she doesn't have to pay for the gas. But if she goes with the car, she has to pay for the gas. So clearly, cost for the gasoline is a relevant cost. Now, the annual cost for the auto insurance and license, which she already paid $1,380 or 13.8 cents per mile. Well, in that case, regardless, since she already, if that's insurance on the car, so either the car is going to stay in her garage and she takes the train, either she's using the car. In both cases, she has to pay the insurance. So basically, the insurance is not some cost that can be avoided. So that will be eliminated in our decision making because in both scenarios, that cost is going to be there. Maintenance and repairs. Maintenance and repairs. So if she goes with the train, she's not going to use the car. If she's not using the car, there will be no need for maintenance and repair. But if she's using the car, that means that maintenance and repair is going to be relevant. So that's why that will be a relevant cost. Parking fee at the school. Well, she already paid for the parking fee, $360. That cost is already gone. So basically, that's a sunk cost, something that's already covered. So that's irrelevant, regardless. But let's see, if the car is in the parking, she has to pay for the car. If the car is not on the parking lot, she still has to pay for the car. So regardless if she drives the car or go with the train, she still has to pay that parking. So that cost is irrelevant. Let's see what the other costs she has. She has an annual straight line. So basically, those are all the costs: annual straight line depreciation, gasoline, annual cost for the insurance, maintenance and repair, parking fees, and total average cost. Also, there's some additional information. Now, reduction in resale value of the car per kilometer of driving the car. So basically, for every kilometer that she's driving the car, that reduces the value of the car. So if she has to drive 230 kilometers one direction and 230 kilometers in the other direction, that cost will be relevant. Now, the round trip of the train, well, obviously, that's the cost of the one alternative. So that's definitely a relevant decision. That's a relevant cost for our decision making. Benefits on the relaxing on the train trip. You have to understand there always will be cost or benefits which cannot be measured. So how can we measure the benefits of relaxing on the train? We can't, but we have to consider it. Cost of putting the dog in the dog house while she's not there. Well, obviously, if she goes with the train, she has to put the dog. If she has to go with the car, she still has to put the dog. So that cost is the same in both alternatives. So that cost is irrelevant. Now, benefits of having the car with her while she's driving. Well, that's one thing that we cannot measure, obviously. It's always nice to have a car or alternative transportation so that makes you independent, but we cannot measure. The other thing is the trouble that she may have to find a parking spot for her car while she's there. Now that's something that it's not a benefit now, that's more like a negative side, but we cannot measure. So that's also irrelevant. Cost per day to park the car while she's there, definitely that's a relevant cost, because if she goes with the train, she doesn't have to pay that cost. So $25 per day is relevant. So let's see what's happened now. Which costs and benefits are relevant to that? As we said, cost of the car, that's the same cost, so that's irrelevant. So anything related to depreciation is irrelevant. Annual cost of insurance is not relevant or irrelevant, because that will remain the same regardless of price. However, the cost of the gasoline, as we said here, is relevant, because that's one of the costs that you have to pay. Maintenance and repairs is relevant, because for kilometers you have to pay that. Monthly scooter parking, that's the same cost, she's already paid, so regardless, that's it. At this point, that we can see that the average cost of $5.69 per kilometer is relevant, and anything else is irrelevant. Now, what else? On the resale value, that's a relevant cost. The round trip, that's the cost of the other alternatives, that's a relevant cost. Relaxing on the train, it's a benefit, but we cannot assign any cost to that, so we're going to ignore it at this point. The cost for the dog, that will be irrelevant, because it happened in the both cases. So which costs and benefits are relevant? Now the cost of the parking obviously will be relevant, because if she goes with the train, can be avoided. Benefits of having the car and the hassle to parking, that's cannot be measured. So let's see what's left. Obviously, what's left is the gasoline, maintenance, reduction of the resale, and the parking. When we combine all those costs, the total cost for the driving the car for her will be $114. The round trip ticket for the train is $140. So at this point, purely based on the cost, we have to advise her to take the train. But since the difference between the cost between the two decisions is only $10, then we have to ask ourselves, well, what will be more beneficial, to have a car with me or not? But that's going to leave it. I'm going to leave it at this point for you, and you have to understand in every decision, there are two measures for alternatives. One is the purely quantitative decision, quantitative measures, which is measured in dollar amount of cost, and the other is qualitative. Anything related to benefits and negative sides, but which cannot be measured or converted into the cost. So that's with the deciding which costs are relevant, which costs are irrelevant. Let's go and find the differential cost approach. What's the differential cost approach? The differential cost approach is the difference between choosing what's going to happen if we choose one thing versus another thing, and what's the difference. So the management of the company is considering a new labor saving machine, which is going to be rented for $3,000 per year. But that's when we rent the machine, obviously we're going to free labor cost. We don't need that people. So in this case, what we're going to do is we're going to see the cost of the machine. As you can see here, the rental cost of the new machine is $3,000. But once we do that, $3,000 going up in the cost side, we release or we're saving $15,000. Our labor cost from $40,000 goes down to $25,000. So the differential approach will be see what are the costs 3,000 obviously is our cost. What's the difference in between the current situation and the new situation with the new rental machine? That we're saving $15,000. So our total saving now, our net saving, let's go net saving here, is not 15,000. Obviously, we're saving 15,000. What we're paying 3,000 for the machine. So our net saving is $12,000. So shall we go with that decision? Definitely. So differential approach again is you're not doing that. You're not preparing a report for the current situation, and you're not preparing a report with the new machine. You just chasing the benefits of having the new machine versus the cost for the new machine. And then you're going to get the net annual cost saving. That's a differential approach. You working only with the differences in cost saving and additional cost. And then you're getting the net cost saving if there's any cost saving, or net cost increase if there's not. That's the case. So the usual using the differential approach is desirable for two reasons. First, you only in a very rare occasion you have enough information available to prepare the detailed income statement. So preparation of the detailed income statement, which is right here, in very rare cases you're going to have that information. So you cannot compare here what's my operating income without having machine and what's my operating income of having the machine. So seeing the final result in the operating income, that will be available in very rare cases. Also, in this case, you have many costs which might not be relevant. But once you're preparing all the detailed income statement, you may make a mistake. And you can make confusion. And you can distract your attention from the actual information, which is critical. So that's why you're going to directly to the method of differential cost. And you are using only the differences, which are the benefits and the cost. Compare the benefits that you're going to have versus the cost that you have to pay, and see the net result and go from there. Adding, and now we're going to start working with a different scenario for decision making. One is the adding or dropping a segment. This is one of the most important decisions that you as a manager have to make one day. Should I keep buying this product, or should I stop buying? Or should I drop this entire product and not produce it anymore, or keep producing it? In this case, we have to work with the relevant cost and how we can use the relevant cost for our decision making. Due to declining popularity of digital watches, this company, which producing digital watches, obviously, right, has not reported a profit for several years. So one of the lines doesn't report a profit. Company considering discontinue or eliminating the product line. What's the decision rule here? Decision rule is for the company. The company should drop the digital watches segment only and only if the profit will increase. This only will happen if the fixed cost saving exceed the contribution margin. You understand the contribution margin is the positive number for you, or something that comes to you as income. Fixed cost is cost. So if we can save more on cost rather than losing the profit, then we can go for it. Let's see how this works. So we have this income statement here. As you can see, for the digital watches, we have sales 500,000, variable, manufacturing costs, shipping costs, commission Our contribution margin from the digital watch is 300,000. Now we have a fixed expenses. General factory overhead 60, salary of line manager 90, depreciation equipment 50, advertising direct 100,000, rent factory space 70, general administrative expenses 30,000. In total, our fixed expenses 400,000. So basically, our net income is actually net loss of $100,000. At this point, we're clearly losing money. But let's see more information now. Investigation that we already made shows us that the total fixed general factory overhead, this general factory overhead 60,000, and general administrative expenses, which is the general, which is $30,000, so 90,000 in total, would not be affected if the digital watches line is dropped. What that means that this $90,000, even if you drop this line, they're not going to disappear. We cannot eliminate the $90,000. Also, the fixed general factory overhead and general administrative expenses assigned to this product will be reallocated to the other product lines. So this $90,000, instead of being here, it's going to go somewhere else. But it's still going to be in the company. So company is not going to save $90,000 if it drops this line. Also, equipment on the depreciation, equipment which we're using to manufacture these digital watches has no resale value, and we cannot use it. So this depreciation in this equipment, even if we drop the line, we cannot use it, and we cannot sell it. So in this case, shall we drop the line? Well, we can. So let's see what currently these digital watches, they make a $300,000 contribution margin. Out of those $400, which are fixed cost, we cannot avoid 60,000 general overhead. We cannot eliminate those ones. So there's going to be still there. We cannot eliminate general administrative expenses. That's now 30,000. And we cannot eliminate the depreciation equipment. So that's in total is 90 plus 50, 140,000. Cost that's going to stay with us. So instead of losing 100,000, we actually, from this digital watches, we have a net profit of $40,000. So let's see if that actually is true. Well, obviously, let's go the other side. If we drop this line, we're going to lose the $300,000 contribution margin. Contribution margin is lost, gone. Why? Because we're not producing any more the digital watches. Once we drop it, which are the costs that we can eliminate? We can eliminate only the salary of line manager, advertising direct cost, and rent factory spaces. Those are the only three costs that we can avoid. The other three costs, as we said, they're going to stay with the company. So once we combine those three costs, our saving of dropping the digital watches will be only $260. So technically, we're losing $40,000 if we drop the digital watches. Another way to look is currently those digital watches making $40,000. So if we eliminate them, we're going to lose those $40,000. So in this case, shall we drop? Obviously, no. The other way you to look at this is if we do comparative income statements. But again, remember, for the comparative income statements, sometimes in the cases, you may not have enough information to do the entire income statement, so you can look at it. In this case, pretend that we have enough information, so we prepare this income statement. So, if we keep the digital watches, Currently, that's our current picture. We have $100,000 loss. If we drop that, that means we're losing the contribution margin. Everything that you hear, it disappears. Now, what else will disappear? Now, the general overhead, it won't disappear. It's still going to be here. We still have to pay for the general factory overhead. Line of the manager, salary of the line manager, that will disappear because once we eliminate the digital watches, we can let this manager go. We don't have to pay the salary anymore. Now, depreciation, however, is going to stay with the company because, again, the equipment has no value for the company, and we cannot resell this machine. So this $50,000 will be our cost, regardless if you have the digital watches or not. The next one will be advertising direct cost. Well, once we don't have the digital watches, we don't need to advertise them anymore. So that $100,000 will be our saving. Rent of the factory space. If we don't have the digital watches, we don't have to rent the space. So that $70,000 is going to disappear. However, the general administrative expenses, since we cannot eliminate them, they're going to stay. So the only cost that we can avoid is 90,000, 100,000, and 7. That's 260,000 benefit that we can have. So the 260,000 benefit, but we already lost 300. We're losing 300, we're saving 260. So basically, we still on the loss. So shall we drop the digital watches? Absolutely not. Now, why should we keep the digital watch segment when it's showing 100,000 loss? The answer lies on the common cost of the product. Now, in our allocation, when we're allocating cost to the segment, we cannot allocate all the cost. We can allocate only the costs which are related to that particular segment or particular division, which we saw the last time on the chapter 11. When you're doing the segment report, if you still remember. Now, our allocation can make the segment look less profitable than it really is. So be careful when you're allocating cost to the different segments. When company is involved in more than one activity in the entire value chain, means that it's vertically integrated. Now, the decision to carry out one or other activity in the value chain internally, or rather than buy from somewhere else, it's called make versus buy decision. Again, anywhere in the company, you're making something by yourself. Now the question is, should I keep making it, or should I go buy it from somewhere else? In your life, for example, when you go home, you're preparing dinner. I mean, if you can cook all this. In new generation, I found out that new generation, you cannot cook. Yeah, it's very strange situation now. It's coming. The new reality is obviously it's brutal. For the guys' part, for the gentleman part. I'm sorry, I don't know if you know the truth, but the new generation girls, now when you make a decision, should I get married or should I not? Obviously, yeah, you're gonna have some benefits, you're gonna have drawbacks, so you have to consider everything. But one thing you should be prepared: the new generation girls, they cannot cook, they don't clean the houses, they don't do the dishes, they don't do laundry. apologize to the girls that they actually can do that, but less and less girls doing this now. So then you have to make a decision. So what should they do? Should they cook at home, or should they go and buy it outside? The problem is, if you don't have alternative to make the dinner at home, because you don't have resources, second, you don't have a person who can actually do it, then you don't have a alternative. Your only alternative is to buy from outside. So there's no decision here to make. But if, for example, you're actually cooking at home, then you can have alternative. The other alternative will be to buy outside. And then you can make a comparison between cooking at home or buying from outside. So, few things that you have to understand. Once you do it at home, you can do it at any time. Also, you're going to have smooth flow of parts and the material. You can control the quality. Once you cook at home, you can control the quality. Quality of the colors, quality of the cooking, quality of the ingredients, quality of the time, everything. And you can realize profits. Now, if you decide to go and purchase from outside, you may take disadvantage will be you're failing to explore the opportunities of trying a new food or to try different cooking. That's another thing. So everything you have to understand, whatever it has advantages has disadvantages as well. So let's see this company. This company manufactures part, which is go for it. And it's used as one of the products. So they're doing this part and they're using it for another value chain in the company. What's the cost? The cost is for direct material, they're paying $9, for direct labor $5, for variable overhead $1, for depreciation of special equipment $3, supervisor salary $2, and general factory overhead $10. So that's the cost that they're allocating to that part. So they come up with the unit product cost of $30. Now, the special equipment, which is using to produce this part, has no resale value. So basically, the depreciation special equipment, that's the irrelevant cost. The total amount of general factory overhead, which is allocated to on the basics of the direct labor hours, would be unaffected of this decision. So even if we stop doing this product, this $10 is not going to disappear. So the $10 is also irrelevant. The $30 product, unit product cost, is based on the 20,000 parts. And the outside supplier has offered to provide the 20,000 parts at cost of $25. So looks like we're paying $30. This product costs us $30. That's how it looks like. But if we eliminate the general factory overhead, which is $10, because we cannot avoid that cost, even if we start buying from outside. So our product cost went down to $20. And since we know the depreciation of that equipment, and that equipment has no resale value for us, that's another $3, which are irrelevant in our decision making. So our actual cost will be $17 to make this 20,000 parts. This company offer us, make an offer, we to purchase from them for 25. So the actual cost for us is 17. That's one alternative, to make it for $17 or to buy somebody for the same part, $25. Obviously, it would be ridiculous for you to spend another $8 per part, or for the 20,000 parts, that will be, how much will be that? $8 times 20,000. Who's going to tell me? 8 times U, it looks like it's 16. And when you put the zeros, that's come up with $160,000. So the question is, do you want to pay for the part that you're making, to stop making it and pay somebody $160,000 more to have the same part? I mean, depends. Again, with the new generation, you may end up paying higher price. I'm sorry that I have to bring the reality to you. So let's go again. Which are the relevant costs? Relevant cost is the outside purchase price of $25. In total, 500,000 because we buy 20,000 units. Then we have direct material, direct labor, variable overhead, and supervisor salary. The depreciation and general factory overhead are irrelevant. So basically, our cost is $17, and 17 times 20,000 is going to be $340,000. So our cost to make 20,000 units is going to be $340,000. If you want to buy, we have to spend $160,000 more. So in that case, shall we make it? Obviously, I'll leave that answer to you. Opportunity cost. Let's see what's another cost. Opportunity cost is the benefits which are forgone as a result of pursuing some course of action. Opportunity costs are not actual dollar outlay, because opportunity cost is something that's going to happen if something else happens. So basically, you're not paying that cost right now. And those are not recorded on the income statement of the organization. So basically, what shall we do with those opportunity costs? Well, definitely we have to consider the opportunity cost. Because again, this is something that's going to happen if something else happens. So here we are more on the preventing side. So that is going to happen with the special order. Special order is a one-time and one-time only order that is not considered to be part of the normal business of the company. So when we're analyzing special order, we have to consider only the incremental cost and benefits. So we have to do the differential analysis. So we can work only on the incremental costs and benefits, which are relevant for our decision. Let's see the example. This company makes a single product, which in normal course of action, they're selling it for $20 per unit. Foreign company comes and make a special order. They say, listen this, I need 3,000 of your products, but I'm going to pay you only $10. Are you willing to sell me those 3,000 parts? So this is one-time order and one-time order, which will not going to affect the company or regular business. Now, the annual capacity of this company is 10,000 units. Currently, they're producing and selling only 5,000. The question is, shall we accept this or not? Well, there are a few things that we need to consider. First, let's see the income statement of this company. Currently, again, they're selling 5,000 units, producing for $20. Now, they have a variable cost of $40,000. 40,000 divided by 5,000 units that they're producing, they come up with the $8 variable cost. That brings them contribution margin 60,000. 60,000 is enough to cover the fixed cost. So they're obviously with 5,000 units, they're above cost, they're above the break even. So currently, since the contribution margin covered the fixed cost, they're above break even, so they're making profit. And what was the tricky part with the cost volume profit analysis. Once you're above the break-even point, every dollar that flows to the contribution margin goes directly to the net operating income. Why? Because you already covered the fixed cost. So every dollar, so if they make $1 per product, that $1 is going to go directly to the operating income. So what they have to make sure, that they have to make sure that the special order, the unit, the sales price per unit, covers the variable cost per unit. As long as the sales price per unit covers the variable cost per unit or even higher, it's okay for you to make it. Why? Because it's going to provide a positive contribution margin. And since you cover the fixed cost, every dollar in the contribution margin is going to flow directly to your operating income. So let's see in this case. This company, they offer us $10 per unit for 3,000 units. So they're offering $10 per unit. Our variable cost is $8 per unit. So in this case, we're going to make $2. Our contribution margin for those special order will be $2, but we're making 3,000 units. They want 3,000 units. So $2 times 3,000. So from this special order, we're going to generate $6,000 income. Let's see if that's the case. So if we accept this special order, the incremental revenue will exceed the incremental cost. How are we going to do that? So the increase in revenue will be 3,000 times $10, 30,000. As we already said, since we are both break even, the only thing that we need to consider is the variable cost. The variable cost will be 3,000 times $8, 24. So our contribution margin from this sale will be 6,000. And since we already covered the fixed cost, that 6,000 goes directly to the operating. Now, this answer assumes that the fixed costs are unavoidable and the variable manufacturing must be incurred to the special orders. I'm going to stop this recording here.